Managing one's finances is like a long and winding road. Carefully navigated, we try to traverse the many curves and pitfalls that suddenly appear before us. But why go it alone? Alternative Tax Management Private Client Group helps put you in the driver's seat with holistic, tax-centric planning solutions that may minimize the impact of life's greatest expense, taxes. Selling investment real estate, a privately held business, or another appreciated asset? Looking to reduce the tax exposure from high earnings, stock options, or bonus incentives? Would you like to go from tax-burdened to tax-free with your retirement assets? Get educated through our no-commitment free consultations and get connected to a carefully vetted network of financial, accounting, legal, real estate, and insurance professionals. Who's on your team? Alternative Tax Management.
Hello, ladies and gentlemen. My name is Jason Pischel, and I am the Managing Director for Alternative Tax Management. We are a holistic tax planning platform that partners with other professionals such as financial advisors, accounting, insurance, real estate professionals to provide tax advantage solutions to accredited investors. Today, we are going to review some strategies in the One Big Beautiful Bill Act that you can utilize to help reduce some income tax for your clients. And I think I like that One Big Beautiful Act name about as much as the Inflation Reduction Act. I don't know where they come up with these names. I think that was Trump's deal. But today we are going to have a lot of good content. I'm going to hit you with a lot of information. The objective is really to get you acclimated to high-level concepts that you can recognize situations that you might be able to implement reduction for your clients. And today's focus is going to really center upon capital expenditures and the bonus depreciation. We are going to talk about qualified opportunity zone funds, and we are also going to review a little bit about our platform, Alternative Tax Management, and how you could work with us. So starting with capital expenditures, this is really a big addition to the tax bill, which is bringing back 100% bonus depreciation for equipment. And you need to look at capital expenditures in two different segments. And Section 263 discusses capital expenditures and outlines how businesses treat capital expenditures. It also differentiates between costs that offer long-term benefits and those that only benefit in the current year, which are immediate expenses. So it really kind of pertains to capitalized costs over associating them with acquiring and producing and improving tangible property versus expensing them in a single year. So further, segmenting the capital expenditures, you have Internal Revenue Code 168K, which is the one that was really impacted the greatest by the most recent bill for bonus depreciation. What it does is it provides an additional first-year depreciation deduction for the cost of qualifying property in the year placed in service. And the Big Beautiful Bill permanently returns bonus depreciation to 100%, allowing investors to write off the full expense of this equipment in the current year, which is a major benefit. And there's no cap or limitation to the amount to which you can utilize the bonus depreciation. When comparing it to Section 179 expenses, which are immediate expenses, the 179 expenses are limited to $2.5 million for 2025. And again, it's really focused on immediate tax deductions for qualifying expenses and things that can be expensed in a single year. In 2026, that cap goes up to $4 million. But for today's purposes, we're really going to focus on bonus depreciation because that was the aspect of the big, beautiful bill that increased that to 100%. We're going to start by talking about cost segregation, which is a very popular way for real estate owners to accelerate the expense write-offs for acquisitions of real estate. So when looking at real estate, you need to segregate the components of real estate in 4 different capacities. First is the land, the actual physical land that is underneath the property, or that is the property. Land can't be depleted or depreciated, so no deductions for the land. The building itself can be depreciated over a 27.5 to 39 year period. If it's commercial real estate, it's 39 years. And then to the right side of the screen, we've got the different components that you can actually segregate out and use the new 100% bonus depreciation. There's first personal property, which includes furniture, carpeting, and different aspects of within the property. And then land improvements, which is mostly outside the property, which includes sidewalks, fences, and different components like that. So previously, personal property, it was being depreciated over 5 to 7 years. That's the amortization schedule. And land improvements over 15 years. Both of these can now be depreciated in the current year using 100% bonus depreciation. So cost segregation, without cost segregation, basically you're taking the building and you're able to depreciate the building most likely over that 39 years, and then have the land, which isn't depreciable. When you're using cost segregation, you can see that you're stripping out the different components within the building and reducing the allocation of your depreciation to the building. That is a much slower process to depreciate, and you're accelerating the personal property and the land improvements. So let's take a look at what this means from a financial standpoint. It is actually a really big deal for property owners when you take a look at the financials. Looking at the top section without cost segregation, it's just straight line. If the building cost $8 million and the land was $2 million of that acquisition price, you would be able to straight line depreciate the building over 39 years, thus taking a $205,000 depreciation deduction each year. And so my comparison is the first 3 years of deductions, and comparing the first, which is without cost segregation, you're able to deduct $615,000 total over the course of the first 3 years. When using cost segregation, you can see that we've still got the land, which is $2 million. You're not able to depreciate, but we've segregated the building and assumed that the building itself was a $6.4 million cost, and the land improvements, $800,000, personal property, $800,000. We're now able to accelerate all those deductions to 100% in the first year. And so the $6.4 million for the building is still drawn over the 39-year period. So there's a $164,000 deduction instead of the $205,000. But the huge difference is all the accelerated deductions can land in the first year for land improvements and personal property. So your first 3 years, I really should have just done the 1 year, but your first 3 years is $2 million basically of deductions as opposed to $600,000. So cost segregation for real estate is first on my list for major benefits to all the real estate investors out there. I've got a few other strategies that I'm going to talk about today when it comes to capital expenditures, including solar development. We work quite a bit with solar development, and with solar development, you're able to write off 100% of the components of the solar in the first year. And, with the next 3, including the solar I'm talking about, leverage is a major, component of the total return, because the more that you can acquire cost wise for the equipment, obviously the bigger the deduction you're able to take in the current year. So looking at leverage in these different programs, it is a very important aspect, and some are more limiting than others. Typically, what we see from a solar development standpoint is a leverage of about 50 to 60% on the equipment. So if you're investing $100,000, say, the total cost of your equipment would be probably 200,000, and then you're able to actually deduct the full 200,000 off your taxes. And previously, without the 100% bonus depreciation, we were in a situation where it was sunsetting. So we did have 100% depreciation several years back, but it dropped from 100 to 80 to 60 last year, and we were in a year where it was at 40%, and it was going to continue to decline next year to 20 and 0 the year after. So bringing back 100% bonus depreciation and locking it in actually permanently is a huge deal for these different equipment type programs. Not only do you have the bonus depreciation aspect for the solar, you also have tax credits. Now, this was one of the negative components if you're a solar fan, because the OBBBA bill did basically phase out solar tax credits. IRC section 48E and 45Y federal tax credits, 30% is allowable through 2027. Previously, with that Inflation Reduction Act bill from a couple of years ago, they had locked that in place until 2032. So the most recent bill has reduced that from 2032 down to 2027. This is going to really change the landscape for solar development, because the developers that I've talked to really feel that it's probably not economical on a commercial level unless you are the one that's utilizing the solar components as an investment. It's probably not really viable without the tax credits, using the depreciation alone. And so the important aspect of, what we're able to do still with the tax credits is this year, next year, and the year after, if you plan correctly, you've got a runway of the 100% bonus depreciation, and you can still use the tax credits, but construction must be initiated within 12 months, basically from today, or the projects must be placed in service by December 31st of 2027. And then, with the solar, cash flow is obviously a component. There's a power purchase agreement that's typically in place with what's called an off-taker who is buying the electricity, and that electricity sales covers the debt aspect of the investment project and also creates an income stream, typically, which is reserved for the developer and the sponsor of the solar program. So as a tax equity investor coming in for solar, usually what the benefit is right up front immediately is tax credits and depreciation with a modest cash flow over a period of time and a buyout when you exit. So let's take a look at a chart that kind of visualizes one potential scenario with the solar. As I mentioned, typically it's 50 to 60% leverage. So you can see the investment amount in this illustration is $100,000, which acquires a solar basis of $200,000. This assumes a federal tax rate of 37% and California 12.3%. So the investment tax credits in this scenario would be $80,000, and the cash value of the depreciation, now the federal depreciation is $160,000. Excuse me, I'm going to try to stay out of the weeds. Because it's not 200,000, because there's a rule that you have to minus out half of your tax credits. So that's $40,000. So it's 160,000 that you're able to depreciate on a federal level, and you can take 100% of that in the current year, and then 200,000 on a state level. Now, most states, including this example that's California, they're not going to let you utilize the bonus depreciation all in the current year. There's only a very small handful of states that conform on a federal level with the bonus depreciation. Colorado's one, Delaware's another one. There's only a very small handful. So most of the states you're running parallel income schedules where you're taking 100% of the depreciation in the current year for the federal, and then on a state level, your income is going to be higher because you're amortizing and using the MACRS schedule over a 6-year period. That said, the cash value of the depreciation is $83,000. So all in the first year, the benefit in this example hypothetical illustration is $163,000. Excuse me. Actually, I believe I gave you the cash value of the state over the 6 years. So the total value is 163,000. As I mentioned, the cash benefits are modest for these programs. Most of them, that's the reason the developer and some of the folks are putting the deal together. They're going to coordinate the cash flows and the debt payoff, and they'll get the majority of the cash benefits. As investors, we get the tax benefits. So not a big deal for the cash benefits, 10,500 in this example. For total tax and cash benefits of 174,000 on a $100,000 investment, most of which is coming, the year that you enter. Now, we're going to talk a little bit about recapture in a few slides, but again, getting into the weeds, and hopefully some of the CPA friends on the line here are with me on this. And you have a capital account that you have to track when you're an investor, which basically shows your investment versus the amount of expenses that you've taken against that investment. And with the solar, you go below your capital account. So you are going to recapture and pay a tax upon exit, typically, unless you're donating the project, which I've seen in some places. So the recapture tax does figure in when you exit, and then you minus out the investment costs. In this example, the net benefit ends up being about a 53% return, which is super strong because you're getting more like a higher return in the year you enter, and you end up paying a little bit on the exit. I did want to highlight a few other types of capital expenditure programs that I've seen in the marketplace. I will tell you and share with you that solar is my favorite, and I'll tell you why after I go through the next two. So accessory dwelling units, also referred to as ADUs. I've heard them called tiny homes. I've heard a lot of different language for this. We looked at these a few years back and just really liked the solar better. Now, ADUs are, as I mentioned, they are tiny homes. They're small units, which are basically modular, prefab constructed units where they could be dropped in someone's backyard for an Airbnb type setup. They can be used for workforce housing, which I've seen some of the oil refining groups in Texas. They create basically fields for worker housing using these ADUs, but it's deemed equipment. And so looking at the ability to deduct, it's all about deductions on the upfront of these different types of investments. So it's got the same amount of leverage. Typically, it's going to be 50 to 60%. And this one actually could be a combination of Section 179, which are immediate first year expenses, and 100% bonus depreciation. But the bottom line is you can write off the whole cost of these ADUs in the first year like you can the solar. And again, cash flow is being generated from workforce housing. A lot of them are Airbnbs. They can be less expensive rental type units. I was talking to some developers out in California, and they were looking to do a lot of different ADU type situations throughout California just because the land is so expensive and people are willing to pay pretty good rent for a small trailer type apartment. And so, there's a lot of viability for these units. And then when you exit, you either get bought out or, again, could donate this. So why I like solar better than this, couple of things. First off, you don't get the tax credits. Tax credits are a pretty big deal when it comes to the immediate impact of your tax benefits. You're basically getting the same expense deduction. You're getting the 100% bonus depreciation. The cost is going to be virtually the same, because if you're using the same amount of leverage, let's say it's 50%, your 100,000 investment still getting you the same $200,000 of depreciation. You might be able to write off the full 200 instead of the 160 for solar, because you're getting the tax credits with solar. But your total return from the tax deductions is more powerful with the solar. And then you have the comparison of, all right, so what is generating the income that's paying off that debt, which is vastly important, obviously, because if the debt doesn't get paid off, then your deal falls apart. With the solar, you have to get through the first year of the amortization schedule, and the first 6 years actually, where if something happens within the first 6 years, there is a potential clawback of those tax credits and the depreciation that you've taken. So with the solar, you're really kind of focused on that schedule of depreciation. And same with the dwelling unit. So it's really important where your income stream is coming from. So the last one of capital expenditures I wanted to highlight is equipment leasing. And, this isn't new. Equipment leasing's been around for 20, 30 years. So with equipment leasing, at least the versions that I've seen lately are very high levered offerings of 80 to 90%, which is one reason why, probably the most significant reason why I just really never got comfortable with it. Now, I'm not saying it's not a good strategy for some folks that might be very wealthy who could take on the exposure of a significant debt, but 80 to 90% leverage, if you're investing $100,000, you're getting 800 to 900,000 of debt. And by the way, you are indirectly personally responsible for the debt in varying degrees. Usually with the solar, you're buying in through an LLC, you're creating an LLC structure and you're buying into the solar. So you are protected a little bit with an LLC structure, and you could default if it ever came to you, where they were looking for payment of debt. But, the deals that we've looked at, you're subordinate to the developer and the sponsor of the program. So the likelihood is pretty small that you would have to incur any type of debt payment. And, with the ADUs, similar type thing where, you are subordinate. With the equipment leasing, you do have that significant exposure, which is, more than most people's mortgage. You're able to take the 100% bonus depreciation. And so because you have such a large acquisition as a percentage of your equity, it is a much bigger deduction for you. And so in that sense, as far as a return goes, this is going to be the most powerful return. If you're just comparing what's my financial benefit side by side, the equipment leasing is going to give you the best deduction. But we're looking holistically at, well, all right, so what's the risk factor of the payment of the debt? What's the exit going to look like? What's my recapture exposure? And you're taking on significantly more risk because of the debt exposure. And obviously with the equipment, it's basically the lease payments of the equipment. And I think some of the programs out there do have really good sponsors with companies that have good experience leasing equipment. But ultimately, again, it kind of comes back to the comfort level of having such a significant level of debt. Now, on all of these, there's some important items to note. There are deduction rules that come into play with material participation. For most of these, you can't just write a check. You have to actually have what's called material participation. And that means that you have to have a certain number of hours participating in these various programs. With the solar, I know you can get individual projects where your threshold, because you're not commingled with other investors, your threshold is 100 hours. And usually that's obtained through participating in a diligence visit to look at the projects. You're given access to a lot of different documentation that you can review, but it just can't be studying the landscape of solar or, equipment and ADUs. It has to be specific to the actual project. And so it really needs to be dialed into the specific project that you're working with, and not just kind of educational content on the industry as a whole. Now, if you aren't individually acquiring these different assets and you're commingled with other assets, other investors, the requirement increases to 500 hours of active participation. So there is that material participant requirement, which is significant because I don't think I've heard of anyone being questioned to show their proof of material participation. But if you were audited and the IRS has asked you to prove that you're a material participant and you aren't able to come up with your 100 hours, then you're stuck using these benefits against passive income only, which is still a viable way to use these if you have real estate income and other types of passive income. But most people don't have enough of that type of income to make it worth their while. But I will add that, if you're a real estate investor and you've got significant real estate, or you have other types of passive income that you're generating, you don't have to be a material participant. You could just write a check, and then those benefits that you receive would apply to your passive income only. The next item you want to be careful with is excess business losses, Internal Revenue Code 461. Now, this limits the amount of business losses that can offset non-business income. And so what that means is you have to be careful, how much you're trying to use against your income that isn't generated by the business that's creating the deductions. And for single filers, it's 313,000. For joint filers, it's 626,000. So basically, if you had income that wasn't generated by either the solar or the equipment or the ADU, you're only able to offset 626,000 of your personal income using these strategies. So it's not limitless. And if you don't use all the deductions in the current year, you are able to roll them over into future years. And then the last one to note is, I mentioned it before with the solar and these other programs do have an aspect of depreciation recapture, where because you're using leverage and you're taking a deduction based on an amount that's greater than your investment amount because you've used leverage, the cash flow that you receive along the way contributes to grow in a positive way to your capital account, but most have a negative balance when you exit. And think of it similar to real estate. If you're depreciating real estate and you sold the property for a profit, you would have to recapture that depreciation. The same thing applies to these equipment type programs, where when you exit, if you have a negative capital account balance, there is going to be some type of recapture tax. All right, I'm completely shifting gears here. So that was talking about bonus depreciation, which really is a big deal, being locked into place permanently. The other really big deal when it comes to our investment scope is qualified opportunity zones. We've been working with OZs for the last, going on 8+ years, when they were created by the Federal Tax Cuts and Jobs Act in 2017. And basically, these are low-income census tracts nominated by the state governors of each state and certified by the Department of Treasury. And currently, there's over 8,700 opportunity zones across the country. Roughly 10% of America is an opportunity zone. And all of it really got started from it was Cory Booker in the Senate and a few other congressional folks who were friends and working with some wealthy Silicon Valley entrepreneurs, early investors in PayPal and some of these different companies who were sitting on a mountain of capital gains, and they were very socially, progressive and wanting to help out the communities around them because they saw that they were in Silicon Valley and making a ton of money and very wealthy, but they drive through these lower poverty areas in San Jose that really could use an upper lifting. And so the proposition was, if we sell our IPO stock, we're going to get crushed with these capital gains. Can we work out some kind of deal that we can sell these appreciated assets and utilize the capital gain to do good by investing in these communities that need a helping hand, get a tax benefit along the way so it incentivizes us to do this, and thus opportunity zones were created. So we're at the tail end of the first iteration of the Opportunity Zone Fund. Right now, the only benefits available for the current fund are two things. You've got a temporary tax deferral. Anything that you've created as far as a capital gain this year, you've got 180 days to roll that into a qualified opportunity fund, and that will be deferred. Your tax basically falls off the balance sheet for 2025, and then it resurfaces December 31st of 2026. So you're getting, about an 18-month deferral if you invested right now. But the bigger benefit's always been, I compare it to a Roth IRA for capital gains. The biggest benefit has always been the money that you actually invest in these programs grow in these higher trajectory return investments. They grow tax deferred, and then if you're in them for 10 years, they come out the back end when you liquidate tax free. And it's always been a growth of wealth play. And so looking at the current fund timeline, reinvest capital gains within 180 days this year, your capital gains resurface the end of next year, and then you've got 10 years of growth and they come out the back end tax free. Looking at this illustration, this really could apply to a Roth IRA. It's the same concept. What this is $1 million capital gain, assuming that you had a 30% tax rate. That 30% tax rate is composed of 20% capital gains tax, 6.2% state tax, and 3.8% net investment income tax for this illustration purpose. And then assuming they paid that tax outside of the Opportunity Zone investment and they rolled the entire $1 million into the OZ fund, or they chose not to and kept it in a taxable account, assuming that they grew 10%, the total appreciation would be 1.6 million. And again, this assumes in the taxable account, you're not getting taxed each year along the way. You're paying it at the end, a complete lump sum tax of $478,000. The benefit of the Opportunity Zone, not having to pay that tax, obviously that's huge. And I threw in a $22,000 growth of your deferred tax because you do have time value of money. You were able to keep a tax that you owed the government for 12 months. But the bottom line for this return profile is you've got $500,000 more money because you utilize the Opportunity Zone Fund structure for your capital growth, so 24%. Now let's take a look at the new iteration. This is tremendous. Not only did they reinvigorate the old bill, but they've made the Opportunity Zone Fund permanent, and they've made it on a rolling 10-year basis. And so this is very similar to what the original one looked like when it first came out. The first benefit is temporary tax deferral, but you're not deferring for 1 year with this. You're starting with a 6-year deferral. So I think we're going to have a huge year for Opportunity Zone funds in 2027 because your window of deferral, if you start in 2027, it doesn't catch up with your tax until December 31st of 2033. Let me go over that again. So So if you have a capital gain that you've triggered in 2027, you've got 180 days to roll it into the Opportunity Zone Fund. And then it doesn't resurface on your taxes until December 31st of 2033. So you have 6 years of use of that tax money that should be the IRS, that they're giving you that time value of money for that whole period of time. Benefit number two. So again, the first iteration had this as well, but we're almost at the end of that, so it's impossible to get a 5-year step up. But benefit number two, if you're in the OZ fund for 5 years, you get a step up in basis of 10%. So what that means is if you rolled in $100,000 capital gain, it goes up 10% your cost basis. So really you're only paying tax at that point for $90,000. So the 100,000, 10% step up, your tax liability is only on paying taxes on 90,000 instead of the 100. They also added, this is new, they added for rural developments a step up in basis of 30%. Now, I guarantee you, a lot of the sponsors that we work with are shopping for rural land in different areas right now, because that 30% step up is a pretty big deal. So if the development, I don't know specifically, I think they're still working out the details and what is characterized as rural, but that is a 30% step up. So again, if you started with 100,000 capital gain, now you're only paying tax on 70,000 of the capital gain. And some of the programs that we've seen and worked with in the marketplace, they also have the ability to mark up expenses and price in different costs associated with the capital gain. And the rule is, it's the capital gain on the day that you triggered the transaction that created the capital gain, the value on that day, or the day that the tax deferral sunset is over, which is December 31st of 2033. So if you could say that you've got a 30% step up and costs and expenses have eroded your capital gain, I'm sure that there's programs out there that can have markdowns of 50, 60% on those capital gains. Benefit number three has not changed. Remember my comparison, the Roth IRA for capital gains. So that's what it is. And let's take a look at the timeline, and then we'll take a look at an example like we did for the first one. 2027, you reinvest within 180 days. And again, it's a rolling 10 years. So 2028, you start a new 10-year window, you can get a 5-year step up. The only thing that doesn't roll is that the December 31st, 2033, I believe that deferral window is in place. So the deferral ends for all the different windows at that point. And then 2037, you get your tax-free 10-year. So let's look at the financial illustration once more, this time with the new benefits in place. So same scenario, you paid the tax outside the investment, you rolled the $1 million into the Opportunity Zone or the taxable account. It grew and compounded 10% per year. So you ended up with the same 1.59 million. Same scenario outside the OZ, you paid the 478,000 in taxes, but you've got, for the OZ fund, you've got a new deferral window, which I've got 6 years in compounding and use of that money, time value and growth of that tax deferral. I've got marked at $172,000 benefit. That's a significant period of time. You're able to keep that money, reinvest that money into other investments and grow that money. And the value of the step up in basis, so 30% on $1 million, that actually should be a higher number. Or that's the tax on $300,000, so $30,000. And then backing out the initial investment, your final after-tax value for the taxable account is 2.1 versus 2.7. So your outperformance in the OZ has gone up to 680,000 or 32%. So again, really significant benefits a great way to supplement retirement income and long-term wealth. So here's my plug back to the heart and roots of my background, which is alternative investment investing. So, alternative investments, which all of these kind of fall under, are healthy in a holistic scenario for most clients anyway, particularly the opportunity zone fund investments. They are low correlated to traditional stocks and bonds, and by incorporating them into a portfolio with other types of assets, it makes the whole portfolio more efficient. And the opportunity zone funds come in all different types of flavors. We've seen multifamily, that's predominantly the most popular out there because it's the most fitting for the widest swath of these different opportunity zones. Workforce housing, we've seen student housing, self-storage, life sciences, even oil and gas. The Permian Basin sections of it are considered an opportunity zone. So lots of different ways to diversify. Now I'm going to do a comparison. I keep calling it a Roth IRA for capital gains. I really do think that's a great comparison. So let's do that. Let's compare the two. So the Roth IRA, you fund with any after-tax proceeds. So you're paying the tax. You're not taking a deduction like you do a regular IRA. You're paying the tax. So you've already paid the tax and you're growing your capital tax-free. With the Opportunity Zone Fund, you're utilizing only capital gain proceeds. So let me clarify and make sure everybody knows that when you sell an asset, so let's say you invested 500,000 in NVIDIA stock and it grew to $1 million. These are real life scenarios for several clients I've worked with. So when you sell the $1 million, you get to keep the 500,000 cost basis and you're stripping off the $500,000 of capital growth. And that's what's getting rolled into the Opportunity Zone Fund. You're not rolling the entire amount in like you would for like a 1031 exchange for real estate. You're only stripping off the capital gains and using those proceeds. So the capital gains tax also may be deferred. With the Roth IRA, you're paying the tax immediately. With the OZ funds, you've got that deferral period of having to catch up with that capital gains tax. With the Roth IRA, potential tax-free growth of wealth. Same thing with the Qualified Opportunity Zone Fund. But I will add that we spent the first chunk of our webinar today talking about capital expenditures. Guess what? That's what they're using with the Qualified Opportunity Zone funds. Inside the Opportunity Zone funds are a lot of different types of cost segregation type assets or equipment that they're able to do accelerated expenses and depreciation for the properties. So most of the programs that we've seen actually generate completely tax-free income based on the amount of deductions they're able to send to you. And by the way, all that typically comes on a K1. So you're going to see your income, and then they're going to give you another line item separately that shows the expenses that you can allocate against that income. And one of the great benefits of the Opportunity Zone Fund structure, unlike real estate, when you depreciate real estate each year and you sell it for a profit, you have to recapture. With the Opportunity Zone Fund structure, even though you're doing that real estate the same as you are outside the fund structure, inside the fund, when you do it in the OZ, there's no recapture tax. That's one of the added benefits of an Opportunity Zone Fund. So when they talk about tax-free income, like receiving a 6 to 8% tax-free distribution over your 10-year hold period, you get to keep that. There's no recapture when you exit for a profit. So that is a big deal. Roth IRA, you've got a minimum hold for 5 years when you invest in a Roth IRA. With the OZ fund, it's 10 years. But you know what? I'd love to make that comparison because one of the big pushbacks that we get with the OZ funds is, oh, it's 10 years. It's such a long time. Well, you don't think that when it's the Roth IRA. In fact, most people are just trying to put as much as possible in the Roth IRA. The mindset really needs to be the same for the Qualified Opportunity Zone funds. Last one, penalty tax on Roth IRA if withdrawn prior to age 59 and a half, and no required minimum distributions. With the OZ funds, tax on earnings removed prior to 10 years with no penalty, and no required minimum distributions. So you could see a rational comparison between the OZ fund and the Roth IRA. And I actually would say that the OZ fund is more compelling than the Roth IRA. When you look at contribution limits and different things like that, for a 401k, 403b, your limit's 70,000. With the IRA, Roth IRA, 7,000. But I'll lump a backdoor Roth IRA in with the 401k, 403b. We work with a lot of folks that are doing conversions of 401k, 403b, and rolling them to Roth IRAs. But still, you're limited to these amounts each year. And an OZ fund's unlimited. You can roll as much capital gains as you can create. And that really kind of sums it up. You're only limited by the amount of capital gains that you can create. All right, well, I appreciate your time today. I just wanted to wrap up with a couple of quick slides on our platform, Alternative Tax Management. As I started with, we like to partner with any type of professionals that are working with clients that seek tax mitigation. We've got 3 major tranches of assets that we can help educate you and your clients on: capital transition strategies, be it 1031 exchange or using Delaware statutory trust. We talked about the OZ funds today, charitable structures, income tax mitigation. We're heading into our very busy season for income tax mitigation, where we work with oil and gas programs, discounted Roth conversion programs, passive activity losses that can be offset with passive activity gains. And then solar tax credits, going to be a huge couple of years for solar as they phase out the tax credits, but using the bonus depreciation and tax credits combo can be a super compelling return profile for an investment in tax credits. And we've got some great ways to work with you with not just kind of philosophical and educational ways, but on paper, looking at comparisons between different strategies. What if I plugged in an oil and gas fund versus a solar development? What's the net effect on my taxes? So we can help you with all those conversations that you can have with your client to help them reduce their tax exposure this year. So again, my name's Jason Pischel. I am Managing Director for Alternative Tax Management. I want to thank you for joining us today. We appreciate all your time. And please do reach out if we can be of help to talk with you and your clients about any type of tax strategies. And we look forward to helping you in the future. Thanks again for joining today. Take care.